Hi, everyone. So in this next part, we're going to be looking at lessor accounting. We looked at lessee accounting in the previous part of this module. Now we're going to take a look at it from the viewpoint of the lessor. So in terms of the lessor capitalization versus the operating classification, a lease that qualifies as capital to the lessee is also going to be capital to the lessor. But we add a couple new criteria so that we ensure the collectability of payments and ensure the case that the lessor can record revenue. So for the capitalization criteria of the lessor, we have the group 1 criteria, which are the ones that we are familiar with from lessee accounting rules number 1 through number 4. And of course, we want to start to remember those rules as the transfer of title rule, the BPO rule, the useful life rule, and the FMV rule. But in order to be capitalized by a lessor, we have a couple of extra criteria. And like I said, these criteria are important for revenue recognition. We have to make sure that the collectability of the payments is reasonably assured. We also have to make sure that there are no important uncertainties regarding the amount of costs that the lessor will incur. So we want to get rid of uncertainties and have assurance of payments. Why this? Again, we want to recognize revenue over the life of the lease and sometimes on the day the lease is signed, depending on the type of lease to the lessor. But basically, we're trying to make sure that all of the benefits and risks of ownership have been transferred in the contract. Will the lessee and the lessor always see eye to eye? No. You could capitalize a lease because of something in group 1, but there could be an issue with group 2. In that case, the lessee will capitalize, the lessor will not. So sometimes we'll see the lessee capitalize, but the lessor won't. We will never see, or we shouldn't, not that we would never, but if everything is going smoothly, if both parties are following the rules correctly, we wouldn't see a case in which the lessor capitalized that the lessee did not. Because if the lessor capitalizes, that means something from group 1 was met, and that means that the lessee needs to capitalize. When we're looking at the types of leases that the lessor can recognize, of course, we have the operating versus the capital lease distinction. So we start with the operating lease. If it's classified as an operating lease, remember that we keep the asset on the lessor's books because we haven't had a sale with the contract. The lessee wouldn't record a contract or wouldn't record an asset on their books, so the lessor doesn't remove the leased asset from their books. We recognize rent revenue when we meet the recognition principle, so the rent will be earned over time by the lessor. It's not earned at a point in time. And then we're going to recognize depreciation expense as it's incurred on the lessor's books. Of course, we're going to use the economic life or the useful life, because now we don't have any sort of lease term that's binding the economic life of the leased asset. It's always going to be on the lessor's books. The lessor will use it. They own it. They'll have it for the entire useful life. Capitalized, we can have two options. One option is a direct financing lease. That's when the fair market value of the leased asset equals the cost of the leased asset to the lessor. And so you want to think of it as sort of sale price equals cost of goods sold. And this is all to the lessor. If the lessor is earning interest on this case, but not profit, so because of this equality between the sales price and the cost of goods sold, we don't have any gross profit, so we only recognize the interest revenue that arises over the lease term for the lessor. A direct finance lease, we would want to remove the asset from the lessor's books. We record the lease receivable. That should be a long-term asset. It's equal to the present value of everything. So we're going to include the payments as our rent, PMT, the PV of the GRV, the UGRV, or the BPO. Notice that the UGRV is going to be inputted as a future value for the lessor only. And remember that the first payment is typically made at the beginning of the lease. And so we reduce the lease receivable by that first payment. So it tends to look something like this, where we have a lease receivable recorded that is similar to the lease liability of the lessee. We have a cash payment being received. That is the initial cash payment. And then in terms of a credit, we would want to reduce our inventory by the historical cost of the leased asset. Remember that this is the present value of payments and the future value, less the cash payment. And so that's what the initial entry for the lessor would look like, right? Just sort of the flip opposite of what we see with the lessee. The lessee is recording a leased asset coming in. The lessor is recording a leased asset leaving by crediting inventory. The lessee records a lease liability for the present value of the MLPs. The lessor records a lease receivable by the present value of the payments and the future value. And then we have an amount of cash being dispersed, which reduces my lease liability. So the accounting begins to mirror what happens on the other party's side. But you want to make sure that you understand the distinctions between the two and that there are some differences in how we record items, right? So for example, the present value of the lease receivable includes a UGRV. The present value of the lease liability does not include a UGRV. So these two things will not always be equal, but a lot of the time they will be. When we receive cash, similar to the lessee, we debit cash for the value of the payment, whatever the rental payment was. We have the interest receivable being reduced. And then, interest receivable if we don't receive it right away. In this case, because we're getting cash, that actually would be more correctly stated as interest revenue. Present value of the lease receivable times the discount rate we used. And then the lease receivable is the plug. It's the payoff of principal after interest is paid. Right? So this cash that we are paid by the lessee goes to pay down the interest revenue we recognized over the time period, and then whatever's left over is the payment of the principal. Remember to use the implicit rate only. When we were the lessee, we wanted to use the lower of the two. That's no longer the case. As the lessor, we don't care about the incremental borrowing rate. They earn the rate they set. So whatever they set implicit in the lease, that's what we want to use. Okay. So let's look at some lessor accounting. On 1110, Aubie leases an asset with a cost and fair market value of $247,037 to Tiger. The lease term is 5 years, requires beginning of the year payments of $60,000. It has a 6-year life and a residual value that is unguaranteed of $1,500. Both criteria in Group 2 are met. So, some questions to ask yourself. Is it a capital lease? It is in this case because we have 5 years and the economic life is 6 years. So we've met that criteria, capitalize. We know Group 2 are met because useful life, rule number 3, is met. Plus, both criteria in Group 2 are met, which remember means the payments are reasonably assured or the collectability of payments is reasonably assured, and there exist no uncertainties with costs to be incurred by the lessor. So we know we're going to capitalize it. We know it's going to be a direct financing lease because we have that the cost and the fair market value are equal to each other. They're both equal to 247. So COGS is equal to the fair market value of the leased asset, which is equal to 247,037. So the lessor is not making any profit by gifting or turning this leased asset over, not gifting, but they are going to earn some interest. So now I ask, what is the implicit rate on the contract? In order to figure out the implicit rate, you have the present value to the lessor. This represents a cash outflow because they're giving up an asset. They're giving up this asset and they expect to receive in return payments of $60,000, an unguaranteed residual value, doesn't matter that it's unguaranteed for the lessor, of $1,500. N is equal to 5, that's the lease term. And now I'm solving for I. So you put that into your calculator to determine I, and you get 11%. Remember that the present value has to be of an opposite sign to the payment and the future value, which need to be of similar signs. And the best way to think of it is, what am I giving up and what am I getting? The lessor is giving up an asset worth this much money in order to receive payments and a future value. So these are positive, these are inflows, that's an outflow. That's how I think of it. So now I ask, what end of year entries must be made on 12/31? So we want to be thinking about adjusting entries. Well, in order to do that, let's go ahead and map out what happens here with the carrying value of the lease, and that might help inform us a little bit. So the very first rental payment happens immediately. When we record this lease, I can go ahead, actually, let's do the adjusting entries over here, kind of arrow that off. And let me record the 1/110. That'll make it a little bit more simple. So we receive a rental payment right away as the lessor, so we get cash of $60,000. We would have a carrying value of the lease. Remember, the carrying value of the lease was, or not the carrying value of the lease, but the lease was originally struck at a PV of $247,037. Well, we deduct the first payment from that to establish the lease receivable. So it's $187,037. And then the inventory, remember, we want to remove it at its cost of goods sold, or its cost to the lessor. And so we're going to remove it at its COGS, which I said was equal to the fair value, which is equal to that. So this is our journal entry to record the inception of the lease, and then the carrying value of the lease, $187,037. There is no interest revenue, and so that adjustment brought my PV, $247,037, down to $187,037. Now, when we go to calculate the next payment and interest entry, the rental payment will be $60,000. We want to recognize, remember, interest revenue as the fair value times the market rate. So it's going to be $187,037, this number right here, multiplied by the market rate, which is the rate we used to discount everything, 11%, which turns out to be $20,574. So that's the amount of interest revenue and interest receivable I would record at year end. And again, this is assuming that we have a December 31st fiscal year end where we want to record journal entries at the end of the period so that we can correctly close our books for that period. So now let's look at what happens when we receive cash. We receive cash of $60,000. That will reduce my interest receivable because this will first pay off any interest that is due. And then the remaining amount will go to paying down the lease receivable. So $39,426 is left over. after we take care of our interest. That reduces the carrying value of my lease receivable from 187,037 minus 39,426 yields $147,611. Okay. So the accounting for it rolls forward pretty simply. Now, instead of interest payable and interest expense, we have interest receivable and interest revenue. Rather than paying cash and paying down a liability, we're receiving cash, paying down a receivable, and recognizing that revenue that is interest. The second type of lease that can be recorded by the lessor is a sales type lease. And that occurs when the cost is less than the fair market value. So for a sales type lease, they're going to be a little bit more involved. But the general idea is that since the fair market value is greater than COGS, right? The fair market value, which I've sometimes said is basically equal to sale price, minus COGS gives me gross profit, right? Just an income statement identity. Well, in this case, because in a sales type lease, we have that the costs are less than the fair market value, we will have some gross profit to recognize on the inception of the lease. Okay. In this case, the lessor is earning interest and profit on the transaction because of the fact that the cost is less than the fair value. So if you think about a car, when you lease a car, the dealership is making profit not only by the fact that they are gathering interest revenue from you for selling that car, but they are also getting some revenue on the fact that they didn't pay the full ticket price in order to get the car on their lot. Their cost of goods sold was less than the sale price. So accounting for this type of lease is similar, but again, just a little more involved. You're going to remove the asset from the lessor's books at historical cost. You record a lease receivable, so those two parts are still the same. We have a lease receivable, we receive some cash as the initial payment. We're going to remove the leased asset at historical cost. The lease receivable will still be at the present value of everything. Net the cash. The two things we're going to add to this entry now are a cost of goods sold and sales revenue. We recognize the sales revenue. This arises because the COGS is less than the fair market value. So we get to recognize a profit on the transaction. And then the COGS comes along because we want to match COGS to sales revenue. Sorry about that. My blinds are putting a shaft of light straight on my notes, and I'm trying to correct it. But anyway, so we have this relationship. The sales revenue is going to be a little different in that this is going to be the PV of what the lessee records. And then COGS is going to be the historical cost less the PV of a UGRV. Okay, so this is getting where we start hitting a little bit of complication, that the cost of goods sold is the historical cost of it, which you might figure, but we would subtract out any UGRV. The sales revenue is the present value of what the lessee, is the present value or what the lessee records, because it's the present value of everything less the UGRV. Okay. So why do we do that? Let's think about it. What's going on here? And this is getting even worse. There. So what makes sense for the sales revenue? Essentially, if it were a cash sale, you'd record everything the purchaser gave you. So this is the same idea. You're recording whatever payments the lessee is going to give you. That means you capitalize the payments. You would capitalize a BPO because the lessee is going to buy it from you. You capitalize a GRV because the lessee is guaranteeing that the inventory is going to come back to you at a certain value. But if there is a UGRV, you don't record it because the lessee, the customer, has made no guarantee to return a UGRV to you. Okay, so you don't really sell the UGRV. You only make a sale or record sales revenue for everything, the payments, the future value of a BPO, the future value of a GRV, but not the future value of a UGRV. With cost of goods sold, essentially we are selling the asset in a sales type lease. Therefore, back it up. We're not actually selling. In substance, we're selling the asset because the fair market value is greater than the cost of goods sold. We get to record some sales revenue. Anytime we record revenue, we have to record any expenses that went along with creating that revenue. In this case, that is the asset's cost. So we would want to record the cost of the asset as cost of goods sold. Now, that works in every case except a UGRV. And if you think about it, the UGRV is not being sold. It's not capitalized by the lessee, so it's not included in our sales, and therefore should not be matched to the sale. So you shouldn't include the UGRV in COGS because you didn't have it in your sales revenue. You're matching whatever you put in the sales revenue to your cost of goods sold. Okay, we'll talk more about that in class because that's part that a lot of people typically don't get, and I understand it's not the easiest thing to understand. Let's look at the sales type lease. Let's say the Polaris leases an asset to Kawasaki. The lease term is 8 years. The implicit rate is 10%. The asset's cost is $100,000. The beginning of the year payments are $40,000, and there's a UGRV of $18,000. Assume the FMV of the leased asset is equal to the FMV of the lease to the lessor. So I'm just asking you to say that the leased asset's worth is the PV of the payments and any FV, because I'm asking you to equate the leased assets FMV to the FMV of the lease to the lessor, which means that we include a UGRV because the lessor includes UGRVs. So is this a direct financing lease or a sales type lease? And how would you justify your answer? Well, first thing we have to do is figure out what the FMV of this lease is. So we input a future value of $18,000 that corresponds to the UGRV. We put in the payment of $40,000. We have an interest rate of 10% and a lease term of 8 years. That corresponds to a present value of $243,134. So I would say that this is a sales type lease because the fair value of the leased asset is greater than the cost of goods that I'm selling, the asset's cost. And notice again, in this case, I just asked you to assume that the lease dictates the fair market value of the leased asset. Sometimes I'll give you a value, a fair value of the leased asset. Sometimes I'll ask you to assume that the fair value of the lease to the lessor is the fair value of the leased asset. So that's just one possibility. Now, in order to figure out how we're going to record this, because it is a sales type lease, because it involves a UGRV, we now have to figure out the PG of the UGRV because we want to be able to back this amount out from sales revenue and cost of goods sold. Remember, we're not selling the UGRV, and so we're not including that in our overall price. We're not including that in COGS. We're not including that in sales revenue. We do include it in the lease receivable. So in this particular case, the UGRV is just an $18,000 payment that the lessor is counting on at the end of the lease term. It doesn't involve any annuity payments. The interest is the same. The lease term is the same. And that yields a present value of $8,397. Now, what are the present value of the MLPs to the lessee? This is the lessee that would worry about the MLP, right? There are no minimum lease payments to the lessor. They're the ones that are creating and collecting the payments. In this case, the lessee would record no future value because it's a UGRV. The payments would still be 40. Let's pretend that the 10% is the lower of the two and known by the lessee. And we have an N of 8 years. So in order to use this, we would have to assume that not only does the lessee know the implicit rate, but it's also less than the lessee's incremental rate. So the present value of this is going to be $234,737, which, as you can note, is just the present value of what the lessor records as the lease receivable minus the present value of the UGRV. This is what the lessee would record, and this is what the lessor would record as sales revenue. Okay. So let's look at that and record the journal entry for Polaris and Kawasaki. So for Polaris, who's the lessor, we would record a lease receivable. And remember, this is the present value of everything minus the cash payment that we receive initially. So that comes to 203,134. Remember, the present value